You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Right now, the exact same institutions that literally print the money sitting in your bank account, the global central banks,
Right.
they are quietly trading that paper money in for physical gold. And, I mean, at a historic, unprecedented pace.
Oh, absolutely. They are hoarding it right now.
Yeah, they're hoarding it. And that action immediately raises a, well, rather uncomfortable question for you, the listener. What do they know about the global economy that you don't?
It's a great question because, it's the asset most modern investors just deliberately ignore.
Right. We spend so much time obsessing over, diversification, software stocks, maybe some real estate.
Yeah, the flashy stuff.
Exactly. But we almost never talk about the oldest financial asset on Earth until something breaks.
Right, until something in the macroeconomic plumbing breaks.
Yeah.
And we've watched gold prices do things over the last couple of years, specifically that insane surge up to over $5,500 an ounce.
In early 2026, yeah.
Right. That forced it back into the mainstream conversation.
Right.
Suddenly, everyone wants a piece of the action.
But the second you decide to actually look into it, you just hit this wall of archaic financial jargon.
Oh, it's brutal.
It really is. Bullion, ETFs, spot prices, bid-ask spreads, expense ratios, dealer premiums.
It feels less like investing and more like trying to decipher an ancient language.
Totally. So our mission today is to cut through all of that noise. We're doing a deep dive into a massive stack of 26 market analyses, beginner guides, and institutional research.
Right, to figure out the actual mechanics of adding gold to a modern portfolio.
Exactly. We want to demystify the process, figure out the most cost-effective way to do it, and, build an action plan that respects both your time and your budget.
Because the stakes here are surprisingly high for what people call a safe asset.
Wait, really? High stakes for something that just sits there?
Yeah, absolutely. I mean, if you buy the wrong form of gold for your specific financial goals, or if you get caught up in the hype and buy at the peak of a market frenzy.
Which people do all the time.
Exactly.
Right.
If you do that without understanding the hidden costs, you can turn what is supposed to be a stabilizing force into a very painful financial leak.
Okay, let's unpack this. Think of your investment portfolio as a toolbox.
I like that analogy.
Right. You have flashy tech stocks. Those are your power tools. You have steady bonds, maybe some real estate. But what is gold?
It's the wrench.
Yes. It's the durable, no-frills wrench. It's not flashy, but you absolutely need it for balance.
It's essential.
So to build a sturdy toolbox, you first need to decide what kind of wrench you're buying. Let's start at square one.
The first fork in the road every new gold investor hits.
Exactly. Are you buying the actual physical metal, or are you buying a paper fund that tracks the price of the metal? Direct physical ownership versus price exposure.
Right.
I want to look at the physical side first because, I think that's where everyone's mind naturally goes. You picture a vault.
You picture bars of gold. Yeah.
Right, heavy, shiny bars.
Well, the industry uses the term bullion for that, and it's vital to separate bullion from jewelry.
Okay, so not my 14-karat gold watch.
Definitely not. When the sources refer to bullion, they are talking about investment-grade physical gold that meets a rigid purity standard.
How pure.
Specifically, it has to be a minimum of 99.5% pure gold.
Wow. Okay, so we are talking about highly refined, standardized metal.
Exactly.
Now, reading through the beginner guides, there seems to be this major debate between buying those heavy cinematic gold bars versus buying minted coins.
Yeah, that's a classic debate.
My initial instinct is if you're going to buy gold, a bar just seems more efficient. It feels like a serious investment.
Well, a bar is highly efficient if you are a sovereign nation or, a billionaire making a $10 million purchase.
Right, if I'm a central bank.
Exactly.
Yeah.
The manufacturing cost per ounce is slightly lower when you pour one massive brick. But for the individual investor, the research overwhelmingly points toward coins.
Oh, really? Why is that?
Specifically, globally recognized government-minted coins, like the South African Krugerrand, the Canadian Maple Leaf, or the American Eagle.
Why government coins, though? I mean, does the stamp on the metal actually change the underlying value of the gold?
It doesn't change the gold's intrinsic value, but it fundamentally changes the liquidity.
How so?
Think about the friction of trying to sell a solid 10-ounce gold bar. If you take that to a random dealer, they have to verify it.
I guess they can't just take your word for it.
Right. They might need to drill into it or run an ultrasound on it to ensure it isn't filled with tungsten.
Wait, tungsten? People fill gold bars with other metals.
Oh, yeah. Tungsten has a very similar density to gold, so it's a common counterfeiting trick. So verifying a bar takes time, and it raises suspicion.
Okay, that makes sense.
But if you walk in with a standard 1-ounce American Eagle, that coin is backed by the United States Mint.
So it's instantly recognizable.
Exactly. The Secret Service actually polices its counterfeiting. Every dealer on the planet knows its exact dimensions, its exact weight, and its exact market value on that specific day.
I hadn't even considered the verification friction.
Yeah.
You want to be able to liquidate quickly.
Liquidity is everything for retail investors.
And I imagine the divisibility matters too. Like, if I have a financial emergency and I need $3,000, I can sell 1 or 2 coins.
Right.
But I can't just saw a corner off a gold bar and hand it to someone to pay my mortgage.
Exactly. That liquidity is paramount. But the primary psychological and financial driver for choosing physical coins over any other method is the elimination of counterparty risk.
Ah, counterparty risk. I see that term constantly in these analyses. Let's define it, because I think it's the core philosophical argument for holding the actual metal.
Counterparty risk is basically the probability that the other party in an investment or a contract will default on their obligation.
Okay, break that down for me.
Sure. Every digital asset you own carries this risk. If you own a share of a tech company, your ownership is essentially a database entry.
Right, on a screen somewhere.
Right. Maintained by your broker, which is verified by a clearinghouse, which operates on servers vulnerable to power outages or cyber attacks.
It's a whole chain of trust.
Exactly. You are relying on a long chain of other institutions functioning perfectly just to prove you own your asset.
And physical gold snaps that chain.
Completely snaps it. If you hold a gold coin in your hand, its existence and its intrinsic value do not rely on a CEO, a banking conglomerate, or a server farm.
It just is.
Right. It is a bearer asset. Whoever holds it, owns it. It is the ultimate off-the-grid financial insurance.
Which brings us to the massive contradiction of the gold ETF.
The exchange-traded funds, yeah.
Right.
Yeah.
I look at this option, and it feels like it fundamentally defeats the historical purpose of buying gold.
It does seem counterintuitive at first.
Right, because if the whole point is to have a tangible, hard asset that survives when the digital banking system freezes up, why on earth would I buy my gold in the stock market?
What's fascinating here is that the ETF was created to solve a very modern problem.
Which is?
Physical friction. Yes, for the purist who wants doomsday insurance, an ETF is pointless. It is a paper claim.
So it's just digital tracking.
But you have to look at how an ETF operates. A massive financial institution buys literal tons of physical gold and stores it in high-security, audited vaults, usually in London or New York.
Okay.
They then issue shares on the stock market that represent a fractional ownership of that hoarded gold.
So I'm basically buying a digital ticket that proves I own a tiny sliver of a gold bar sitting in a vault in London.
Yes, and the trade-off you're making is accepting counterparty risk in exchange for ultimate convenience.
Convenience, because I don't have to carry it around.
Exactly. With an ETF, you can sit on your couch, open your retirement app, and buy $10,000 of gold exposure in 3 seconds.
And sell it just as fast, I assume.
You can sell it just as fast.
Yeah.
You are harnessing the price movement of the asset without taking on the logistical nightmare of handling heavy metal.
Okay, let's talk about that logistical nightmare.
That's a big one.
Because the deeper we get into the sources regarding physical gold, the more I realize the sticker price, scrolling across the bottom of a financial news network, is a complete illusion for the retail investor.
Oh, absolutely. It's totally misleading.
The hidden costs seem astronomical.
Because the price you see on television is the spot price.
Right, spot price.
That is the wholesale price for raw, unrefined gold being traded in multi-million-dollar contracts between massive banks.
So it's not the price I pay at the coin shop.
Never. As an individual consumer buying a coin, you will never, ever pay the spot price.
You pay the dealer premium.
Exactly.
And the research shows these premiums can be a brutal wake-up call for beginners. I saw numbers ranging from 4% all the way up to 10% above spot price just to buy a standard coin.
Yeah, that's standard.
Why is the markup so high?
Because you are paying for the entire supply chain. The raw metal has to be refined, minted into a beautiful coin, shipped securely in an armored truck to a wholesaler.
Wow, okay.
And then shipped again to a retail dealer who has to pay rent for a secure storefront and, pay a staff.
So all of that overhead gets passed to me.
Right. That entire physical logistics chain is baked into the premium you pay over the spot price.
Yeah. Okay, let's say I accept the premium. I buy the physical coins. My immediate instinct, and I'm guessing this is what most people do, is I just put them in that little fireproof lockbox I keep my passport in.
Under the bed.
Yeah. Or maybe hide it in the back of the closet. I feel like that solves the counterparty risk. But reading through the security protocols in these guides, I'm starting to think that's a terrible idea.
It is arguably the most common unforced error a new investor makes.
Really? Just keeping it at home?
Keeping highly concentrated, untraceable wealth unsecured at home is a massive vulnerability.
Unsecured, meaning a normal safe isn't enough.
A standard home hardware store safe can be breached in minutes with basic tools. Or, honestly, a burglar can simply pick it up and carry it out of the house.
That is terrifying. So what is the actual requirement for storing this stuff safely?
You basically have two realistic paths. The first is a professional-grade home safe.
Professional grade, like a bank vault.
Pretty much.
Right.
We are talking about a TL15 or TL30 rated safe that weighs hundreds of pounds.
Hundreds of pounds.
Yes. And it must be bolted directly into the concrete foundation of your home.
You have to drill into your foundation.
Exactly. And on top of that, standard homeowners insurance rarely covers significant amounts of bullion.
Wait, really? So if it's stolen, I'm just out of luck?
Unless you purchase a specialized, expensive rider on your policy, yes.
Okay, that sounds like a massive headache. What's the second path?
Third-party vaulting.
Okay, what is that?
You pay a specialized storage company an annual fee to keep your gold in their maximum security facility.
Like Fort Knox for regular people.
Kind of, yeah. But notice what just happened to our off-the-grid asset.
Oh. You are now paying an ongoing annual fee to a corporation to hold it for you.
Exactly. Which, ironically, reintroduces a layer of counterparty risk.
Because you have to trust the vault company.
Right. You have to trust they actually have it and won't go bankrupt.
Let's compare this directly to the costs of the ETF, because this is getting complicated. I assume the digital route is cheaper, but, like, how much cheaper?
Drastically cheaper. With an ETF, there is no dealer premium when you buy. The shares trade exactly in line with the spot price of gold.
So no 10% markup.
Zero markup. Your ongoing cost is called an expense ratio, which covers the fund's vaulting and administrative costs.
And what does that usually run?
For major gold ETFs, this is usually less than 0.5% per year.
Wow.
And most modern brokerages have eliminated trading commissions, so buying and selling the shares is essentially free.
I want to make this tangible. Let's walk through a mathematical scenario based on the cost structures outlined in the research. Let's assume the spot price of gold is sitting at a nice, even $2,000 an ounce.
Okay, $2,000 spot.
And I have $5,000 in cash that I want to allocate to gold today. What happens if I go the physical route?
At $2,000 spot, a coin with a typical 6% or 7% dealer premium is going to cost you roughly $2,140.
Okay.
So if you take your $5,000 and divide it by 2,140, you walk out of the store with about 2.33 ounces of gold.
Wow. So I have instantly lost a chunk of my purchasing power to the dealer's markup. I started with enough money for 2.5 ounces, but I only get 2.33.
Exactly.
And if I put that same $5,000 into an ETF...
Because the ETF shares track the spot price without that retail markup, your $5,000 buys the equivalent of exactly 2.5 ounces of gold exposure.
So on day one, I simply own more gold.
Yes. On day one, you own more. Yes, the ETF deducts a tiny fraction of a percent over time for management, but mathematically, starting with 2.5 ounces instead of 2.33 puts you in a vastly superior position for compound growth or protection.
But the friction doesn't stop at the purchase, does it? The sources highlight two massive hurdles when you decide it's time to sell: the bid-ask spread and taxes. Let's tackle the spread first. If I take my physical coin back to the dealer, they aren't going to give me the spot price either, are they?
No dealer stays in business by buying at retail and selling at retail.
Right.
They have a bid price, which is what they will pay you, and an ask price, which is what they charge a buyer.
And the gap between those two numbers is their profit margin.
Exactly. Now, during normal market conditions, that spread might be relatively tight. But during a financial panic, when volatility spikes, dealers widen that spread aggressively.
To protect themselves from inventory risk.
Yes. So just when you might need the money the most, the cost to liquidate your physical gold becomes the most expensive.
Whereas an ETF trades millions of shares a day, so the spread is usually a fraction of a penny.
Exactly. It's instantly liquid at a fair price.
That makes perfect sense. But the tax argument in the sources completely threw me. Why is the IRS treating investment-grade gold bullion as a collectible?
It's bizarre. Right.
It isn't a rare stamp or a piece of fine art. It's a standardized financial asset.
It is a very frustrating quirk of the U.S. tax code. It stems from legislation like the 1997 Taxpayer Relief Act.
Okay, what does that mean for me?
The IRS categorizes physical items, art, antiques, gems, and yes, physical metals differently than capital assets like stocks or bonds.
How much differently?
If you hold physical gold for more than a year and sell it for a profit, you are subject to the collectibles capital gains tax rate, which can max out at 28%.
28%. Compared to normal long-term capital gains on stocks, which usually max out at 15% or 20% for most people.
Right.
That's a massive penalty just for holding the physical version of the asset.
It is. And it's worth noting that while some specific gold ETFs are structured as grantor trusts and still face the collectibles tax, many other gold-related funds or physically backed vehicles have structures that allow them to be taxed at standard equity rates.
So what does this all mean?
The fundamental takeaway from all these hidden costs is clear.
Right.
Physical gold is heavy with friction.
Right. It costs more to buy, it yields less when you sell, it requires money to secure, and the tax treatment is often punitive.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Exactly. For a beginner whose only goal is to diversify their portfolio and hedge against inflation, the math aggressively points toward the ETF.
It's the cleaner, cheaper, highly liquid choice. You are buying the financial function of gold without the logistical nightmare.
You have to separate the romantic idea of holding a pirate's treasure from the reality of efficient portfolio management.
I love that. A pirate's treasure versus a portfolio. All right, I think we have a solid grasp on the how. But we have to address the giant, glittering elephant in the room. The when.
The timing. Yeah.
Because a beginner listening to this might be convinced to buy an ETF, but then they pull up a historical price chart and immediately freeze.
It's a scary chart right now.
Let's talk about the absolute wild ride gold has been on recently. The market dynamics of 2025 and early 2026 rewrote a lot of assumptions about precious metals.
They absolutely did.
The timeline in the sources is staggering. Throughout 2025, gold pushed past $4,500 an ounce, setting over 50 record highs.
50 record highs in 1 year.
And then in January 2026, it absolutely exploded, hitting an all-time peak of $5,589 an ounce.
It was unprecedented.
But since then, it has pulled back significantly, hovering in the $4,000 range.
Right.
I'm looking at this chart, and it looks suspiciously like a classic bubble. I have to ask the question every beginner is agonizing over. Did we miss the boat?
It's a very fair question.
Are people who buy in at 4,000 just catching the leftover hype of a moment that has already passed right before it crashes back to 2,000?
The fear of buying at the top is the most rational fear an investor can have. But to determine if this is a bubble, we have to look at the mechanics driving the price.
Okay, let's look at the mechanics.
A bubble is usually driven by retail speculation. Think of the dot-com boom or meme stocks, where amateur investors pump up a price based on euphoria and message boards.
Like the GameStop craze.
Exactly.
Yeah.
That is not what drove gold to 5,500.
So what was the catalyst? Because that is a huge spike.
Structural macroeconomic shifts. Primarily, the de-dollarization trend and the aggressive actions of global central banks.
The central banks again.
Right. The people who manage national reserves in countries like China, Poland, Singapore, and India have been accumulating physical gold at a staggering velocity.
But why the sudden rush? They've held U.S. dollars in their reserves for decades.
Because the geopolitical landscape fractured. When nations observe intense global sanctions, trade wars, and the weaponization of the U.S. dollar in foreign policy, they realize something.
Which is?
That holding their national wealth in a currency controlled by another government is a massive vulnerability.
Oh, wow.
Gold is a stateless asset. It has no counterparty risk on a sovereign level.
So it's not tied to any one country's success or failure.
Exactly. Furthermore, as global interest rates began to shift and confidence in fiat currencies wavered due to persistent debt issues, central banks sought the ultimate historical anchor.
So this wasn't a bunch of day traders pushing buttons on their phones on their lunch break. This was sovereign nations backing up literal truckloads of metal to protect their national economies.
And that fundamental driver has not disappeared just because the price pulled back to 4,000. The demand floor is heavily supported by institutional and sovereign buying.
So the pullback isn't necessarily a bubble bursting.
The pullback from 5,500 was a natural market correction, profit-taking by early investors, and a slight stabilization in some short-term economic indicators.
But even if the fundamentals are strong, the sources are incredibly clear about the danger of market timing. They explicitly warn beginners not to look at that $4,000 price tag, assume it's a discount from $5,500, and dump their entire savings account into a gold ETF all at once.
Oh, please do not do that. That is how you get wiped out by short-term volatility.
Right.
Lumping all your capital into a highly emotional market is a gamble, not an investment strategy.
The proposed solution in the research is something I'm a huge advocate of, but I want to break down exactly how it applies to a volatile asset like gold. Dollar cost averaging.
Dollar cost averaging, or DCA. It is the ultimate defense mechanism against your own psychological biases.
Explain how it works for someone who might be new to the concept.
Instead of agonizing over whether $4,000 is the right price today, you remove price from the decision entirely. You commit to investing a fixed dollar amount on a fixed repeating schedule.
Let's run a hypothetical. I decide I want to allocate a portion of my paycheck to gold. I commit to buying $200 worth of a gold ETF on the 1st of every month.
Okay, perfect. So in a month where the price spikes back up to $5,000, your $200 automatically buys fewer fractional shares.
Right, because it's more expensive.
But in a month where the price drops to $3,500, that exact same $200 automatically buys more shares, scooping up the asset at a discount.
So I'm buying more when it's cheap and less when it's expensive, automatically.
Exactly. Over the course of a year, your average purchase price smooths out the wild peaks and valleys of the market.
You aren't trying to catch a falling knife or chase a runaway train.
Right. You are gently and systematically building a position over time.
And if you are absolutely dead set on the physical route, you can apply the exact same logic. You make a rule. I will buy one small, 1/10-ounce coin every 6 months, regardless of what the news is screaming about the spot price.
It shifts the entire mindset.
It really does. You stop viewing gold as a lottery ticket where you need to buy low and sell high in a panic, and you start viewing it as a long-term defensive wall around your wealth.
Defensive is the key word there, which naturally transitions into the most critical part of this entire discussion.
How thick should that defensive wall be?
Exactly, the golden rule of allocation.
I found it fascinating how consistent the sources were on this. Whether I was reading a conservative banking report or a more aggressive investment blog, the consensus was virtually identical. They all recommend keeping your total gold allocation strictly between 2% and 10% of your investable assets,
with 5% to 10% serving as the sweet spot for the vast majority of retail investors.
To put real numbers on that, if you have a combined net worth in your 401k, your IRA, and your brokerage accounts of $100,000, a 5% allocation means you hold exactly $5,000 worth of gold.
Right. The other $95,000 is deployed elsewhere.
But I have to play devil's advocate here.
Go for it.
If central banks are hoarding it and the geopolitical landscape is a mess and it hit record highs, why artificially cap myself at 10%? What happens if I decide to go 30% or 40% into gold?
If you push your allocation that high, you are colliding with gold's fundamental mathematical flaw as an investment vehicle.
Which is?
It produces absolutely nothing.
Warren Buffett talks about this all the time. He has that famous quote about how gold just sits there and looks at you.
And he is absolutely correct in his assessment of its utility. Think about what a share of stock represents.
It's ownership in a company.
Right. Ownership in a living, breathing corporation. That company is hiring brilliant engineers, inventing new technologies, expanding into new markets, and generating quarterly profits.
And a portion of those profits is often paid back to you as a dividend.
Exactly. Or take a bond. A bond is a loan that pays you a predictable stream of interest. These assets perform economic work.
And gold.
Gold does no work. It generates no cash flow. It pays no interest. Its entire value proposition relies purely on capital appreciation.
The hope that someone else will pay you more dollars for it tomorrow than you paid for it today.
Precisely.
I want to use a metaphor here because it really crystallized the concept for me.
Yeah.
Think of your entire financial portfolio as a massive cargo ship trying to cross an ocean.
Okay, I'm with you.
The destination is your retirement. The stocks and the bonds in your portfolio are the engine and the sails. They harness the wind of human innovation and corporate earnings to propel the ship forward.
Right, they generate the speed.
But gold is not the engine. Gold is the heavy iron ballast sitting in the very bottom of the hull.
That is a brilliant way to conceptualize it.
The ballast doesn't push the ship forward. In fact, because of its dead weight, it technically slows the ship down a tiny bit during clear weather.
Because it's tying up capital that could be in a growth asset.
Right. But when a massive economic hurricane hits a market crash, hyperinflation, a geopolitical crisis, and the wind tries to capsize the ship, that heavy, unmoving ballast is the exact thing that keeps the ship upright.
It stabilizes the journey.
But follow the logic of the metaphor. If you decide to fill 40% or 50% of your ship's cargo hold with deadweight ballast, what happens?
The ship sinks. Or at best, it moves so slowly that you never reach your destination.
Exactly. Financially speaking, over-allocating to gold creates a massive drag on your compound growth.
You are taking your best wealth-generating players off the field and replacing them with inanimate metal. You need enough ballast to survive a storm, but not so much that you sacrifice the growth required to actually build long-term wealth.
Hence the strict 5% to 10% boundary.
It's a boundary for a reason.
It's a sobering reality check.
Yeah.
And it leads to a necessary warning. The sources don't just tell you how much to buy. They are very clear about who should avoid buying it entirely.
Yes, there are definitely people who should just walk away.
If we are handing out an action plan, we need to outline the profile of the person who should look at this entire deep dive and say, I'm out.
The first disqualifier is a short time horizon.
What counts as short?
If you need the capital you are investing within the next 3 to 5 years, maybe for a down payment on a house or a child's college tuition, gold is far too volatile.
Because it could drop right when you need the cash.
Exactly. You could buy today at $4,000, and in 3 years the market could cycle down to $2,800. You wouldn't have the decades required to wait for a recovery. You would lock in a devastating loss.
What about the debt side of the equation? I imagine trying to buy gold while carrying high-interest debt is mathematically self-destructive.
It is the ultimate opportunity cost error.
Explain that.
If you are carrying a balance on a credit card charging 22% or 24% annual interest, that debt is compounding against you faster than almost any asset could ever grow.
Right. Gold isn't going to outpace a 24% credit card.
There is no scenario where buying a gold coin mathematically outperforms the guaranteed return on investment you get from aggressively paying off a 24% debt.
So, if you have high-interest debt or if you lack a liquid cash emergency fund of 3 to 6 months living expenses, you have no business buying precious metals.
Zero business. Gold is a sophisticated diversifier for an already healthy, established financial foundation. It is not a life raft for a sinking personal budget.
Okay. We've established the baseline. We know the difference between physical coins and digital ETFs.
Right.
We understand the hidden costs of premiums and storage. We've contextualized the 2026 price surge, and we've firmly anchored the strategy in a 5% to 10% DCA approach. That covers the vast majority of beginners.
It's a solid foundation.
But I know there are listeners who are fascinated by the mechanics of the market and want to look beyond the basic ETF or the physical coin. The sources briefly outline a few alternative vehicles. I want to dig into these.
There are some interesting, albeit riskier, options.
Here's where it gets really interesting. Let's talk about gold mining stocks. Instead of buying the metal, I'm buying shares in a company like Newmont or Barrick Gold. The company's physically extracting the metal from the earth.
Okay, mining stocks.
My initial read on this was that it was just a proxy for the gold price. Like, if gold goes up, the miner goes up. But the sources warn that it is significantly more complex and potentially much more dangerous.
Oh, it is vastly more complex. Buying a mining stock introduces a profound layer of operational risk.
Operational risk.
Right. If you own a physical gold ETF, your only variable is the global spot price of gold. If you own a mining company, you are now exposed to the commodity price, plus the reality of running a heavy industrial corporation.
Meaning I have to worry about the CEO making a disastrous acquisition.
Or a labor strike halting production at their biggest mine. or an unexpected flood destroying their equipment.
Oh, wow. I didn't even think of natural disasters.
Or, quite commonly, geopolitical risk. A mine might be located in a developing nation that suddenly decides to nationalize foreign-owned assets or drastically increase royalty taxes. You absorb all of those equity risks.
So why would anyone do it? Why take on all that corporate headache when you could just buy the ETF?
Because of a mathematical concept called leveraged exposure.
Leveraged exposure. What does that mean?
When a mining company is well managed, its stock price doesn't just match the price increase of gold, it multiplies it.
Walk me through the math on that. How does the leverage actually work?
Let's create a simplified model. Every mining company has a metric called all-in sustaining costs, or AISC.
KISC.
Right, this is the total cost to pull 1 ounce of gold out of the ground, refine it, and pay all the corporate overhead. Let's imagine a miner has an AISC of exactly $1,500 per ounce.
Okay, $1,500 to produce it.
Now, let's say the global spot price of gold is $2,000 an ounce. The miner sells their gold for $2,000, subtracts their $1,500 cost, and they generate a profit margin of $500 per ounce.
Okay, that makes sense. $500 pure profit per ounce.
Now, imagine the spot price of gold has a great year and increases by 25%. The price goes from $2,000 to $2,500 an ounce.
Okay.
If you owned a standard gold ETF, your investment just went up 25%. Not bad.
Not bad at all. But what happens to the miner?
The miner is now selling their gold for $2,500. But their costs to dig it out of the ground are largely fixed. It still costs them roughly $1,500 to produce it.
So their profit margin just jumped from $500 an ounce to $1,000 an ounce.
Exactly.
Wow. The underlying asset only went up 25%, but the company's actual profit just increased by 100%.
That is leveraged exposure. Because of that expanding profit margin, the stock price of that mining company might soar 60% or 70% in response to a 25% move in the gold price.
That's incredible. It offers explosive upside potential during a gold bull market.
But I'm assuming you see where this is going.
That blade cuts both ways.
Brutally so. Let's run the math in reverse. Gold drops 20%, from $2,000 down to $1,600.
Okay, the ETF investor loses 20%.
But the miner, their profit margin shrinks from $500 down to just $100 an ounce. Their profits just collapse by 80%.
And the stock price will crater.
Absolutely crater.
So mining stocks are absolutely not the stabilizing ballast we talked about earlier.
Oh, no, they are not.
They are an aggressive, highly volatile growth play that happens to be tethered to a commodity.
That is a crucial distinction. Do not buy mining stocks expecting them to protect your portfolio during a crash.
Right.
They are equities, and during a severe stock market panic, they will often crash right alongside the rest of the stock market, regardless of what the physical metal is doing.
That is a massive revelation. Okay, let's pivot to something that sounds much safer, but also much more bureaucratic. The gold IRA.
Ah, the gold IRA.
You can't watch a financial news channel for 10 minutes without seeing a commercial for one of these.
The gold individual retirement account. It is a highly specialized, tax-advantaged vehicle available in the United States.
The pitch always seems to be like, use your retirement funds to hold physical gold completely tax-free. It sounds like the perfect hybrid of the physical coin security and the ETF's tax efficiency. But the sources dedicate entire chapters to the friction involved here. What is the catch?
The regulatory framework is the catch. The IRS has incredibly strict rules regarding what assets can be held in an IRA. You cannot simply buy a handful of American Eagles, toss them in your home safe, and declare it a tax-sheltered IRA.
Because it violates the self-dealing rules.
Exactly.
So how does it actually function?
You have to establish a self-directed IRA through a specialized custodian, a financial institution explicitly authorized by the IRS to manage these unique accounts.
Okay, step 1, specialized custodian.
Then you fund the account, and you instruct the custodian to purchase IRS-approved bullion on your behalf.
Oh, okay. Sounds simple enough.
But the critical part is that you cannot take physical possession of it.
Wait, I can't hold it?
No. The gold must be shipped directly to an approved third-party depository, often massive vaulting facilities in places like Delaware or Texas.
So I have the tax advantage, but I've completely lost the off-the-grid appeal. I'm relying on a custodian and a third-party vault.
Right.
And I assume none of these specialized services are free?
The fees are the primary drawback. You pay a setup fee to the custodian. You pay a transaction fee when they purchase the metal, and you pay ongoing annual storage and administrative fees to the depository.
Ouch.
These fees are significantly higher than the near-zero costs of holding an ETF in a standard Vanguard or Fidelity IRA.
So who is this actually for?
A gold IRA only mathematically makes sense for investors with very large portfolios who are ideologically committed to holding physical metal and are willing to pay a premium for the tax shelter.
Okay.
For a beginner with a $10,000 retirement account, the flat annual fees of a gold IRA will eat your returns alive.
So for the beginner, keep it simple. Standard IRA, standard ETF. I think we have covered the gold spectrum thoroughly.
We really have.
But before we pull all this into our final action plan, we have to acknowledge the other metal that inevitably enters this conversation: silver.
Of course. Silver always comes up.
Every time someone looks at gold and sees a $4,000 price tag, their eyes inevitably drift down the screen to silver, sitting there at maybe $30 or $40 an ounce.
It looks like a bargain.
Right. The immediate beginner instinct is, I can't afford a whole ounce of gold, so I'll just buy a massive stack of silver instead. It's the exact same thing, just cheaper.
It is a very common assumption, but it fundamentally misunderstands the economic forces that drive the two metals. They are not interchangeable.
Break that down for us. Why shouldn't I view silver simply as diet gold?
Because they serve completely different functions in the global economy. Gold is almost exclusively a monetary asset.
Meaning it's money.
Right. It's held by central banks, it is
Yeah.
held by investors, and a portion is used for jewelry. Very little of it is consumed by industry. Its price is driven by macro forces: inflation fears, currency devaluation, and interest rates.
And silver.
Silver is a schizophrenic metal.
Schizophrenic.
It has a historical role as money, yes, but today, over half of the global demand for silver is industrial.
Industrial demand. For what?
It is arguably the most conductive metal on Earth. It is essential in the manufacturing of solar panels, electric vehicle batteries, medical instruments, and advanced electronics.
Oh, wow. So its price isn't just tied to inflation fears. It's tied to the actual health of the global manufacturing sector.
Exactly. If the global economy enters a severe recession, industrial demand for silver plummets. Factories stop ordering it.
And when that happens?
The price of silver can crash violently, even if investors are trying to buy it as a safe haven. It is significantly more volatile day to day than gold.
Really? More volatile?
Oh, yeah. During a market shock, gold might drop 5%, while silver could drop 20%.
It's a completely different risk profile. It's not just a cheaper alternative. It's an industrial commodity play intertwined with the green energy transition.
That's a great way to put it.
If you are buying it, you need to understand you are strapping in for a much wilder ride.
It demands a stronger stomach and much closer monitoring.
All right, we have navigated an immense amount of territory today in this deep dive.
We really have. We covered a lot of ground.
We've dismantled the physical versus digital debate. We've exposed the hidden costs that eat away at your returns. We've contextualized the 2026 price explosion. And we've firmly defined gold's role as the stabilizing ballast in your financial ship, capped at that crucial 5% to 10% mark.
The key takeaways.
Now, the entire point of this deep dive is not just to feed you trivia, it's to equip you to act. We have synthesized a concrete 5-step action plan directly from the institutional sources we've analyzed. If you have decided you need this ballast, here is exactly how you execute it.
Step 1.
Step 1. Define your why and set your target. Are you buying physical coins because you fear a banking collapse, or are you buying an ETF because you want a frictionless hedge against inflation?
Right. Know your motivation.
Decide your rationale and pick a firm allocation number. Let's say 5% of your total investable net worth.
And step 2. Choose your vehicle.
Right. Based on your why, select either the physical coin route or the digital ETF route. Do not try to blend complex alternatives like miners or IRAs until you have mastered the basics.
Keep it simple. Step 3.
Step 3. Implement the dollar cost averaging rule. Do not look at today's price and dump your life savings into the market. Build a system.
I will buy $150 of a gold ETF on the 15th of every month.
Exactly. Or I will buy 1/4 ounce physical coin every quarter. Step 4. Force the execution. Look at your calendar right now. Pick a specific date within the next 14 days to make your first fractional purchase or to open your brokerage account.
Because ideas die in the planning phase.
Ideas absolutely die in the planning phase. Force the first action. And finally, step 5, the audit. Set a calendar reminder for 6 months from today to review the asset.
Did it perform the way you expected relative to your stocks and bonds?
Is it providing the psychological comfort you anticipated? Assess and adjust.
I think that framework removes the anxiety from the process. Gold is a tool. It is highly accessible, regardless of your net worth, provided you approach it with a disciplined, mechanical strategy rather than an emotional reaction to a news headline.
It's about taking control of your financial architecture. But as we wrap up, we always like to leave you with a final, lingering thought. Something outside the immediate action plan to chew on.
Okay, lay it on us.
We opened this deep dive by pointing out that the primary catalyst for gold's massive surge over the last few years has been global central banks accumulating physical bullion at record-breaking speeds.
Right.
The sources emphasize this over and over, but I want you to really process the implication of that fact. These are the institutions that possess the ultimate financial superpower. They have the legal authority to print fiat currency out of thin air.
They literally control the money supply.
And yet, when they look at the fragility of the global economic system, their first instinct is to trade the very paper they print for an ancient heavy metal that they cannot duplicate.
It's a staggering reality.
If the architects of our modern financial system are quietly seeking the ultimate off-the-grid insurance policy, what does that reveal about their true confidence in the currency currently sitting in your wallet?
It is a profound macroeconomic signal.
It certainly makes you view that heavy, unassuming ballast in a completely different light. Thank you so much for joining us on this deep dive.
It's been a pleasure.
Take the action plan, figure out your 5%, and as always, keep questioning the consensus, keep exploring the mechanics, and keep learning. We will catch you on the next one.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.